So today we're going to be talking about HECM mortgage, HECM reverse mortgages, or reverse mortgages, better known as HECM's home equity conversion mortgages or senior mortgages. If you don't know who I am, my name is Larry Hughes. I'm a mortgage broker here in Southern California, license number 324686. So I want to get that out of the way for compliance reasons. Again, my California brokerage license number, loan number is 324686. And with that, today we're going to be talking about HECM mortgages for seniors and why they are good, what are the pros and cons of them, and why you should be taking advantage of them. So HECM, again, HECM stands for Home Equity Conversion Mortgage, and really is just a home equity conversion mortgage, or what's better known as a reverse mortgage. It's the government's way or acronym of the HECM mortgage, reverse mortgage, home equity conversion mortgage. So what seniors are allowed to do is to convert their equity in their mortgage from their home, right? So that's a home equity conversion mortgage. And I wanted to grab some materials here, so excuse me. I had a yellow notepad around. It's right there. I wanted to talk about a couple of things. But so while my assistant is getting that, I'm going to tell you about what it's for. Again, it's for seniors who are 62 years or older and own a home, right? You own a home with a lot of equity in your home. And what I mean about a lot, you have to have at least 50% of equity in your home, because what this federally insured program is going to do is going to allow you to tap into that equity without having to go through the payment, having to go through the painstaking of showing that you can repay the debt, right? Because what they're using is that your home's equity as mortgage, as leverage. So let's talk about it. So right now why seniors should be using this. Right now we're in a very uncertain time, right? Right now times are hard. Unemployment is skyrocketing very high, and the real estate market is actually hot right now. Values are high, and the real estate market is doing real good. So the reason why the real estate market is doing good right now is because there's a lack of inventory. Due to the pandemic, no one's moving, right? So since no one's moving, people still have the ability to buy at very low interest rates today. They even throw in the fact the interest rates are in the twos in most cases, and in some cases in the lower threes. Very good interest rate, historic low interest rates. So people have the ability to buy, people are wanting to buy, and when houses come on the market, they're going off the market. Any decent house is flying off the market with multiple offers because the shortage of housing is so low, right? Because no one's moving, no one wants to move during the pandemic. Where are we going to go? How are we going to do this? There's so much uncertainty out there, combined with the fact of high unemployment. One day I have a job, next day I don't have a job. So that being said, housing prices or values are skyrocketing along with low interest rates. That helps out for seniors who want to take advantage of this time to pull some equity. And equity is defined as what you owe versus what the market will pay for your home. So if you owe $300,000 and your home is worth $700,000, you have that $400,000 gap, which is called equity that you have in your home. So for seniors, it is a great way for seniors to tap into equity is a reverse mortgage, because they don't have to prove that they can repay the debt. They're using their equity in their home, converting their equity in their home into a loan. So one of the things that the home equity conversion mortgage or reverse mortgage offers is the ability to have a line of credit. You could be in a situation as a senior not to want to have to borrow money from your home if your home could be paid off or very, very near paid off, and you want to have a line of credit for your home. So you versus a HELOC versus a home equity line of home equity conversion mortgage line of credit, two different things, right? A HELOC, once you start using it, you have to pay it back, right? You can go get it, apply for it, let it sit there. But in uncertain times, the banks will freeze those credit lines, and anything that you have out, they'll just keep asking you to pay for it until it's down to zero. With a home equity conversion mortgage line of credit, you can go get that line of credit and it sits there. Let's say you were in the position where you can get a $200,000 line of credit on a home equity conversion mortgage. It'll sit there. It actually grows year over year, right? So let's say the interest rate is 5%. The federal government guarantees you that 5% plus a half a percent every year, so 5.5%. So this year you're at a $200,000 balance. Next year you're at 210. The year after that you're at 220 something, and it just goes on because the government guarantees if you have a home equity conversion mortgage line of credit versus a HELOC, that money will sit there and grow. And the best thing is it can never be canceled, right? Home equity lines of credit or home equity conversion mortgages can never be canceled. So if you have one of these, as long as you meet the two requirements that you actually live in the home and that you pay the taxes and insurance on the home, it can never be canceled. And again, the caveat to that is that payments are optional. With a home equity conversion mortgage or line of credit, payments are optional. So what happens is you can make monthly payments, you can choose to make interest-only payments, you can choose to make quarterly payments, choose to make yearly payments, or you can choose not to make any payments and let the interest build on the back of the loan. That's the great thing about a home equity conversion mortgage and or a line of credit. So I want to make sure I tell you everything I wanted to tell you. So all right. So again, let's go this also you got to know that 62 years older is your minimum age, and you have a home, own your home, and it has a ton of equity in it, because that's what you're using as collateral for the bank. This is not just some senior mortgage that you get and you owe very close to the value and you can still get it. You have to have a lot of equity in your home. So now what happens in a reverse mortgage, or what happens in a reverse mortgage or reverse mortgage line of credit, is that you, if you use it, again, your value of your home what you owe in your home goes up every year. So if you grab a home equity line of credit and use 50,000 of it, that 50,000 is added to what you owe in the house. And again, payments are optional, but if you choose to make no payments, this year you may owe 250. At the end of this year, making no payments, you may owe 277, or whatever those payments or whatever the interest payments are. And if you continue like that, it will go up and up. However, we're still seeing the appreciation in the housing. So one of the things you have to be aware of when doing this is that as the interest occurs, so does your equity shrinking, right? So again, in this example, you owe $250K. At the end of 1 year, not quoting you an interest rate, none of that stuff, so I won't have to get an APR. But as an example, made up numbers, at the end of 1 year, you could owe, let's just say $270K, right? Because that is the interest of 12 months, 20,000 in an example, not actual numbers. I want to make sure I'm clear on that. So yes, every year over year, your mortgage increases, right? So what you owe increases every month or at the end of every year, because you're not making those payments. Those payments are going in on the back of the loan, versus a forward mortgage is when every time you make a payment, what you owe goes down, right? Goes down just that little much of that principal. So if you look at your mortgage statement and you say my principal and interest, whatever's on that principal is what your payment, what you owe, what your principal balance goes. PRI balance. We're going to sort that. It's what your principal balance goes down by. So if your principal balance, your principal payment this month is $671, you owe $671 less after you make that payment, and not the full $1,500 payment that you may have made. We're just talking about the principal. Remember, you have principal, interest, and if you have an inbound account like most of us do, you have taxes and insurance. Look at that principal line. Whatever principal it is that's how much going down carried into the next month. That's what your balance is. With reverse mortgage, it is the opposite. But for seniors who need it, this is a great way to save money, right? Great way to save the income and money they have. Maybe you're 67, 75, or 70 years old, and you take out a reverse mortgage. You have a $250,000 line of credit on your reverse mortgage, and now you have no more payments for the rest of your life, right? So you have no more payments, but you got income. You have $4,500 a month coming in income, or maybe you didn't plan so well, and you only have $2,200 in income. That income could be used for all your bills, to save maybe for long-term care. As we get older, as parents get older, grandparents get older, they may need some long-term care. Maybe they have to have someone come in the home and assist them. That could be used for that type of stuff, or maybe sending the grandkids to private school, that type of stuff. But that's the gist of a home equity line of credit or a home equity conversion mortgage. Very, very good for seniors who need it or who wants to use it as a savings. Because if you use a home equity line of credit and you have your house paid off as a savings vehicle, you have a house paid off, you have a $200,000 or let's use the example, $250K home equity conversion mortgage line of credit that goes up every year because of the interest is guaranteed to go up every year. This year is $250. If it's 5%, 5% of $250 is 10. Was that $12,000, 12.5 this year. Next year it'd be $262, right? $262,500. So that's if you never touch the money. The next year it goes up another 5%. Therefore, so on and so on. So if you're 70 and you have a 10-year gains, that money can never be taken away from you. That is your money. No matter what your property goes down in value, let's say the stock market and all the real estate market crash, your home equity line of credit will still increase by the current interest rate of the Fed plus 0.5%. So this year it may be 5%, next year it may be 5.5%, or it may move down to 3%. But that's what it is. It's whatever the current interest rate plus 0.5% is what your home equity line of credit mortgage. Home equity conversion mortgage line of credit will go up by. So it is a great program for seniors who want to use it. We have a lot of people sometimes who are confused by it, but it's just that they don't understand what we're not too familiar in what it can be used for. They just think about the negative about their home principal balance going up every year. So let's talk about the inevitable. Inevitable is that one day, whoever takes out a home equity conversion mortgage is going to pass, right? They're going to meet their maker, and then their inherited, their heirs. Their heirs have a couple of options, right? So what's traditionally been thought of a home equity conversion mortgages or reverse mortgages that when the person passes, the bank takes the house away. The bank doesn't take the house away. The bank gives the heirs or whoever's willed the property or whoever gets the property in probate, they give them two options. And they give them 12 months and 2 3-month extensions to get this done. And those two options are refinance, pay us off, and or sell the property and pay us what we owe. That's it. The bank does not take the property, does not have possession rights when they get a home equity conversion mortgage. It only wants what is owed to them when the person either passes or no longer uses the property as their principal place of residence. So that's important to know because that's the very big myth in coming to reverse mortgages that the property gets taken away. And a lot of us have heard of properties being taken away by reverse mortgage. But in reality, if you actually ask someone who is in the situation, it's not taken away because of reverse mortgage. It's that they were given two options and they couldn't meet either one. Or they couldn't meet the first one, which is refinance, right? Because the person at that point has to qualify for the loan. It's fully qualified. You got to go to another lender or Chase or Wells Fargo or a mortgage person like me. You have to sit down in front of them and go over your finances and see whatever the balance is from grandma's house. Can you qualify to actually take that over and go from there? And a lot of times when we hear those horror stories that we lost grandma's house because she had a reverse mortgage, it's only because the persons or the heirs that couldn't qualify, or there's a number of heirs and they couldn't get along and they wanted to sell. Someone wanted their share out of it, and then everyone got together and they sold it either through probate, contested probate, or just everybody agreed to sell it. So that is one of the bad news is about home equity conversion mortgage and reverse mortgages. But they're pretty good for the seniors. Seniors, once they get a home equity conversion mortgage, they're able to travel more. They're able to do the things that they would normally want to do in retirement, but they can't because they're bogged down by their bills and helping people out and stuff like that. Now they free up $2,000, $2,500 a month, or even more. And I'm doing one right now where they're going to free up about $3,000 out a month, and they're going to live life more affordable, right? So with that being said, that's a home equity conversion mortgage. If you're watching this and you have a loved one who would like to learn more, or you like to learn more about a home equity conversion mortgage, let me offer you an example. Let me make you an offer, I should say. Let's run the numbers. Let's look at we have a question?
Mm-hmm.
All right, go ahead. I'm sorry.
Rob says, can you do that with a duplex while receiving the rent from the tenants?
Yes, you can do it from a 1 to 4 unit. Right, so 1 to 4 units is considered a 1 to 4 units considered a single family residence, and you can do a reverse mortgage based on with that, and still receive the rents from the tenants without paying any mortgage. So what I was saying, Rob, I think that's Robbie Cooper. What's up, Rob? If you would like to look at a reverse mortgage, let's do this. Let me make you this offer. Give me a call at 323-228-2736. Again, the number is 323-228-2736. I'll run the numbers for you, right? I'll run the numbers to see what, if you qualify, one, for the reverse mortgage, and two, what that looks like, right? So then you can take it home to the family or take it home to yourself, or if you will have some trusted financial advisors you want to look at it as well. And then, what the numbers look like. And if you decide that you want to make this thing a reality, you want to go ahead and proceed with this, then we'll go ahead and go to step one. And one of the steps that you have to do when doing a reverse mortgage, not just listen to the information that comes from me, but as a senior being a reverse mortgage, the federal government has put into place a counseling to avoid senior abuse, right? So you have to go before over the phone about an hour HUD counseling of someone explaining to you this and much more about the HUD, about the home equity conversion mortgage. And they need to be convinced that you know what you're doing, that you understand what they're telling you. Once you have that conversation and you get a certificate, and then we can move forward. But that is one of the safeguards the federal government has put in place to avoid, again, senior abuse, so that you understand the pros, the cons. Again, the cons only being that your mortgage is going to go up every year if you choose not to make any payments. But and you get your certificate, and then we can move on to step two, getting everything done. So if you want to do that, I'll run your numbers for you. Take a look at it from the financial advisors, the kids, yourself. You call me, let me know, hey, Larry, I want to make this thing real. then we'll go ahead and move on and get you started. Again, I'm Larry Hughes. I'm a mortgage broker here in Southern California. I serve all of California. My license number is 324-686, and you can call me directly at 323-228-2736. Again, the number is 323-228-2736. Thank you all. Talk to you soon. You said we're not knowing, huh? YouTube is go off in stream. Thank you.